The Rebel Capitalist Show. Let's go into the bond market. What are your views on the bond market right now? What is it telling us? And how do you filter out all the noise from the Fed's QE buying bonds and any type of artificial demand that might be there?
Right. Well, up until, this month, and I still am very bullish on bonds, although it's funny that on a daily basis, when bonds go down, people comment and say how wrong I am. But, when you have a macro view, you don't worry about the short-term fluctuations.
Right.
It's, until the data really changes underneath, that it's just noise. But my view is interest rates are across the curve going to go either negative or on the long end close to or hit 0%. And I believe that will likely happen this year.
Can you outline that through the framework of the Fischer equation? Because I just did a video on that with Lacey Hunt. And I think the Fischer equation, for people who don't know, it's very straightforward. It's just that nominal rates minus the rate of inflation equals real rates. But where that really comes into play is if to Dr. Lacey Hunt's point, this isn't mine, I just explained it on a video. If the Fed pegs rates at 0, let's say, and you have deflation, so you have negative inflation, let's say at -2, then the further negative deflation goes, or inflation, the higher the positive rates are for the real economy. And if you have positive real rates going up and up and up, that means less loans or fewer loans out there, because people can't afford to take those loans to buy the cars, to buy the houses, to start the businesses. And therefore, you just have this kind of self-fulfilling, or maybe a positive feedback loop just all the way down. And I think if more people understood or thought through the Fischer equation from that context, I think it would make a lot more sense. So are you seeing things the same way as Dr. Lacey Hunt?
Very similar. I'm a huge fan of his research. In my opinion, he is one of, if not the smartest man in the room when it comes to the bond market. And what I view is, and this is really a very minority view right now, but I am bullish on the dollar. And when you look at the Fischer equation, the big key is if you see a dollar rally, it's going to drive the CPI negative. And when you do the math into real yields, you can get real yields turning positive, which is massively dollar bullish. And that will tighten financial conditions. And as you mentioned, put people right out of being able to get the loans that they need to get.
Yeah, or at least the loans they need to continue expanding the money supply and having more money chasing fewer goods and services in the real economy.
Absolutely. I completely agree with you.
Okay, so let's unpack that a little bit further. So when you're talking about your dollar bullish, that can mean so many different things. So are we dollar bullish against U.S. asset prices? Are we dollar bullish on the DXY? When you're looking at a basket of currencies, it's mostly the euro. Are we dollar bullish when we're looking at our grocery bill? Where are we dollar bullish?
Yeah, great question. I'm dollar bullish on the DXY. And a lot of people ask me, why, Steve, do you focus on the DXY? Well, I don't have a Bloomberg terminal, and I assume that a lot of other people don't. But one of the great things about DXY is you can get it anywhere, and you can get it on the Federal Reserve Fred database where you can chart against other things. So it's very accessible.
Okay.
And I'm bullish on that simply because quantitative easing, despite what most people claim, actually removes liquidity and is bullish for the dollar.
Mm-hmm. I think most people will hear that and they'll be like, what is this guy talking about? How can that even be kind of possible? So can you unpack that for us or explain your rationale?
Sure. A lot of people don't like that, mainly because Fed Chair Powell himself has said that injects liquidity. Unfortunately, he is completely wrong about that, and I know he realizes that. But unfortunately, George, as you know, monetary policy is a lot of psychology.
Yeah.
What most people don't understand about quantitative easing is nothing more than a swap in reserves. So a commercial bank is holding treasury securities, bills, notes, and bonds, and the average maturity is probably a little less than 7 years on those. And what the Fed comes in and does is says, look, we're going to buy this. And there's a schedule that they're running, and they run a 9-day schedule that they rotate every month, and they're buying $80 billion worth of treasuries. Now, because the Federal Reserve Act prohibits the Fed from printing money, they can't actually pay the banks directly for those treasury securities, which is what everyone believes is happening. Instead, what happens is the Fed takes those treasury securities, removes them from the system, takes the cash that they create an accounting entry with, and they deposit it in an account at a Federal Reserve member bank in the name of the bank.
Right.
However, the bank cannot actually withdraw that money. So the bank can count it as a reserve asset to their total reserves, but they cannot withdraw the money. So the bank actually never receives the money and cannot put it back into the economy. So therefore, when the Fed does quantitative easing, they're actually removing dollars from the system. So let's say that I borrowed your car and you said, Steve, I've kind of seen your driving record and I got a really nice car and I want to make sure that, you know, if something goes wrong that I get my money. And so I take a pile of money and we give it to a mutual third party, and I go driving off down the street and you go over to that person and say, I'd like that money, and say, well, it's not yours, George. It's not yours. Now, if the car doesn't come back or something's wrong, then yeah, the contract says we can give you the money. But until then, you can look at it, you can see it, but you can't actually touch it. It is not yours. Right. And that's what people don't understand about quantitative easing. They need to view it as a collateral account where the banks actually don't have the money.
Right. So that's if they're buying assets that are currently on the bank's balance sheet. So let's take it a step further and let's think through. So the bank goes to the primary dealer bank, they go to the auction and they take their cash and they say, okay, we're going to buy XYZ amount of treasuries, and then we're just going to flip that to the Fed. So again, it's this scenario where and I'm using deficit spending for a reason. So again, the cash in the system is going down, we'll call it broad money, is going down in order to buy those treasuries, and it's not going back up because the Fed isn't replacing broad money, they're just increasing base money. But then then that money, let's call it, goes into the TGA, which is at the Fed, excuse me. Then the Treasury spends the money back out into the economy. So now the money's at least back there, but it's not a net positive. It's just a net wash.
TGA account is the Treasury's checking account. Quantitative easing doesn't put any money into the TGA account.
Okay, so if the primary dealer banks are buying the treasuries at auction, that money has to go into the TGA.
So the primary dealers buy it at auction, and even though dealers are owned by the commercial banks, which is where there's some fuzzy stuff here. Yes, that goes to the TGA. The primary dealers then flip it to the commercial banks, who then take their cash out of reserves and pay for the treasury securities. And now they have a treasury security in reserve that goes to the Fed. So the quantitative easing isn't a direct path there. Right. If it was a direct path, it would be money printing. And I just want to be clear for your listeners that, you know, the money is getting there, but it's not a direct money printing path.
Right. So, but then when it's in the Treasury, the money's basically gone from a bank for the treasuries to the Treasury's account, and then the Treasury will spend it back into the economy. So it's not decreasing when they spend it. Initially, it definitely decreases broad money. If you're calculating broad money and that it's cash on the asset side of the bank's balance sheet. But then once the Treasury spends that money that they received from the auction back into the economy, then theoretically, all things being equal, then the broad money would go back up to the level it was before. Am I seeing that correctly?
Well, the problem is the Fed doesn't actually pay the banks for the QE. So the banks have to get cash to buy the next round from their own business services. So from lending and interest on the loans, they're not getting it back from the Fed. That's the critical point.
Right, but my point is it's going from the asset side of, let's call it the cash, is going from the asset side of the bank's balance sheet, and then it's going to the Treasury, then back out into the economy, becoming another liability, a deposit liability for the commercial banking system that's backed up, I would assume, by reserves. But it's going from the asset side of the bank's balance sheet to the asset side of let's say a person's balance sheet who gets a stimulus check. Right.
Yeah. It is flowing, but there is a point where they're because the Fed can only create base money, as you mentioned, that they are pulling that liquidity out of the economy. Now of course, in the system, are we hoping that the TGA money that gets spent as stimulus goes back out and is borrowed and new money is created. Of course, we don't know exactly how that's going to play out. I mean, it's going to vary depending on the consumer. But while there is a flow, there is a little bit of a break in there that people perceive as money printing, but it is not money printing.